A few years ago, I realized something strange. The harder I worked, the more expensive everything became. My rent went up, my groceries went up. My savings stayed the same. And that's when I understood a simple truth. The problem isn't that we're bad with money. The problem is that money itself is broken. Every year, central banks print trillions of new dollars. Your savings get diluted. Your purchasing power disappears, and no one asks for your permission. That's why people are turning to something different. Something scarce. Something that can't be manipulated. Something called Bitcoin. In today's video, we're going to look at why this matters, what's really happening behind the scenes in the global economy, and how you can protect your wealth in a system designed to quietly take it from you. Because once you understand how money works, everything begins with a simple but uncomfortable realization. The reason Bitcoin suddenly feels like it is moving everywhere is not because Bitcoin itself has changed, but because the world around it has, over the last several years, governments and central banks have quietly rewritten the rules of money. When economies slowed, they didn't produce more real value. They printed more currency. Trillions of dollars, euros, and yen were created with a few keystrokes. This wasn't abstract. It showed up in daily life. Rent increased. Food prices climbed. Energy bills became unpredictable. Salaries, however, lagged behind. Even people who felt financially responsible started to notice that their savings bought less and less each year. This invisible erosion is what drives people to look for something different. Bitcoin sits right at the center of this shift. It is not reacting to hype. It is reacting to monetary reality. When people hear that inflation is only 5 or 6%, they think it's manageable. But what that really means is that every year your money loses 5 or 6% of its purchasing power, even if you don't spend it. That creates a subtle sense of panic. People feel like standing still is falling behind. As trust in traditional money weakens, attention naturally moves toward alternatives that can't be inflated away. At the same time, global instability has made people more aware of how fragile financial systems really are. Bank failures, frozen accounts, capital controls, and sudden policy changes have shown that money in the modern world is not something you truly own. It is something you are allowed to access as long as the system permits it. Bitcoin introduces a radically different idea. You can hold value that no government, bank, or corporation can freeze, change, or devalue by decree. When people understand this, even on a basic level, it changes how they think about money. They stop seeing Bitcoin as a risky experiment and start seeing it as an insurance policy against a system that is no longer stable. This is why Bitcoin seems to wake up whenever there is economic stress. It's not magic, and it's not speculation alone. It is the market slowly pricing in the reality that fiat currencies are designed to lose value over time. Every stimulus package, every bailout, every emergency money printing operation adds more pressure to the system. Bitcoin, by contrast, is built on mathematical scarcity. There will only ever be 21 million coins. That number doesn't change no matter what happens in the world. When more people want a limited thing, its price rises. This is not just economics. It is human nature. Another force driving this movement is awareness. 10 years ago, Bitcoin was a fringe idea understood only by programmers and libertarians. Today, it is discussed by hedge funds, corporations, and even governments. More importantly, it is being understood by ordinary people who simply want to protect what they earn. When someone realizes that their savings account is paying 2% while inflation is running at 6 or 7%, they see that they are guaranteed to lose money by doing nothing. Bitcoin offers a different story. Instead of being you are holding something that is becoming scarcer as demand grows. The second key idea builds on this awakening by focusing on the larger forces that push Bitcoin forward, not from within the crypto world, but from the outside. Most people think Bitcoin moves because of news, tweets, or speculation, but those are just surface ripples. Underneath them are massive macroeconomic currents that shape the entire financial system. Interest rates, government debt, currency, devaluation, and global liquidity all flow together, and Bitcoin reacts to these forces like a sensor picking up pressure in the air. When central banks raise interest rates, it becomes more expensive to borrow money. Businesses slow down, consumers spend less, and markets often pull back. When rates are lowered, money becomes cheaper, and borrowing explodes. This creates artificial booms followed by painful busts. Bitcoin was created in response to this cycle. It exists outside of central bank control. So when people sense that traditional markets are being propped up or manipulated, they start to look for something that isn't tied to those levers. Bitcoin becomes attractive, not because it promises stability, but because it refuses to be artificially stabilized. Government debt is another invisible driver. Almost every major country now runs on debt that is so large it can never realistically be paid back. The only way out is to slowly inflate it away by printing more money. This means that, over time, currencies are designed to lose value. Even if politicians promise responsibility, the system itself is built on the assumption that more money will always be needed. Bitcoin stands in direct opposition to this idea. It does not care about debt ceilings, election cycles, or fiscal emergencies. Its supply is fixed, and that makes it a mirror that reflects how unstable everything else has become. Liquidity also plays a major role. When new money enters the system, it has to go somewhere. Some of it flows into stocks, some into real estate, some into commodities, and increasingly, some into Bitcoin. This doesn't happen because people suddenly become crypto enthusiasts, but because they are searching for places to store value in a world where cash is melting. Bitcoin is liquid, global, and accessible, which makes it a natural outlet for excess money. As more capital moves through the system, even a small percentage flowing into Bitcoin can have a dramatic impact on its price. Fear and uncertainty amplify these effects. When geopolitical tensions rise, when banks wobble, or when governments impose restrictions, people feel the fragility of their financial lives. In those moments, Bitcoin stops being just an investment and becomes a way to move value across borders, outside institutions, and beyond control. This is why Bitcoin often surges during crises. It is not because it thrives on chaos, but because chaos exposes the weaknesses of traditional systems. The second keynote is really about understanding that Bitcoin is not isolated. It is plugged into the global economy, responding to every shift in policy, debt, and confidence. When you see Bitcoin move, you're often watching a reaction to decisions made in government offices, central banks, and boardrooms around the world. It is a kind of financial barometer, quietly measuring how much trust remains in the old system and how much is being transferred to something new. The third key idea is where Bitcoin stops being just a macroeconomic story and becomes a mathematical one. At its core, Bitcoin is driven by a simple, almost uncomfortable truth. Scarcity is power. In the physical world, we instinctively understand this. Gold is valuable because it is rare and difficult to extract. Land becomes expensive because there is only so much of it in desirable locations. Art becomes priceless because there is only one original. Bitcoin applies this same principle to money for the first time in human history in a purely digital form. Most digital things are infinitely You can duplicate a photo, a song, or a document endlessly with no loss of quality. For decades, this made the idea of digital money seem impossible, because anything digital could be copied and counterfeited. Bitcoin solved this by creating a decentralized ledger that everyone can verify and no one can alter. Every coin, every transaction, every fraction of a Bitcoin is accounted for in a public system that does not rely on trust in a single authority. This is what makes Bitcoin scarce in a way no other digital asset can be. There will only ever be 21 million Bitcoins. This is not a marketing slogan or a promise made by a company. It is enforced by code and protected by a global network of computers that all agree on the same rules. Even if governments, corporations, or powerful individuals wanted to change it, they would have to convince the majority of the network to go along, which is practically impossible. This fixed supply creates a completely different economic dynamic than fiat money, which can be expanded whenever there is political or financial pressure. Demand, however, is not fixed. As more people learn about Bitcoin, use it, and trust it, demand grows. When a limited supply meets growing demand, the result is upward pressure on price. This is not speculation. It is basic economics. Every new investor, every institution, every country that decides to hold Bitcoin is competing for a slice of the same finite pie. Over time, this competition becomes more intense, because the number of coins does not increase to meet it. Bitcoin's issuance schedule also plays a critical role. New Bitcoins are released at a predictable and decreasing rate through mining. Approximately every 4 years, the reward for mining is cut in half, an event known as the halving. This means that the flow of new supplies slows down over time, making Bitcoin more scarce as it matures. Meanwhile, demand continues to rise as adoption spreads. This built-in imbalance between supply and demand is one of the strongest forces behind Bitcoin's long-term growth. What makes this truly unique is that no human can change it. Central banks can decide to print more money. Governments can rewrite financial rules. Companies can issue more shares. Bitcoin cannot be done. Its scarcity is not based on trust or reputation, but on mathematics and consensus. The third keynote is about recognizing that this structure turns Bitcoin into a kind of digital property, something that becomes more valuable as more people want it, precisely because it cannot be made more plentiful. From understanding why Bitcoin exists to deciding what someone should actually do with that knowledge, once a person realizes that traditional money is losing value and that Bitcoin offers a scarce alternative, the next question becomes how to position themselves in a world that is changing. This is where mindset matters more than timing. Many people approach Bitcoin like a lottery ticket, trying to buy low and sell high, hoping to get rich quickly. That approach usually ends in frustration, because Bitcoin is volatile and emotional markets punish impatience. A long-term perspective changes everything. Instead of asking what Bitcoin will do this week or this month, the focus moves to what it might represent in 5, 10, or 20 years. If Bitcoin continues to gain trust as a store of value, then short-term price swings become less important than long-term accumulation. This is why so many serious investors talk about holding rather than trading. They see Bitcoin not as a stock, but as a form of savings that exists outside the traditional financial system. Another important part of this keynote is owning Bitcoin is not the same as leaving it on an exchange. When coins are held by a platform, they are technically controlled by that company, not by the individual. This reintroduces the same risks that Bitcoin was designed to avoid: frozen accounts, hacks, and institutional failures. Learning how to store Bitcoin in a personal wallet gives people true ownership. It is the difference between having a claim on money and actually having the money. Risk management also plays a role. Bitcoin is powerful, but it is not magic. It should be treated as part of a broader financial strategy, not as a replacement for all planning. Many people choose to allocate a portion of their savings to Bitcoin, while still maintaining emergency funds and other assets. This approach acknowledges both the potential upside and the uncertainty that still exists in a young technology. There is also an emotional dimension to holding Bitcoin. Volatility tests, conviction. Prices can drop sharply, sometimes for reasons that have nothing to do with the fundamentals. During those moments, fear pushes people to sell at the worst possible time. The discipline to hold through uncertainty is what separates those who benefit from long-term trends from those who get shaken out. The fourth keynote is about adopting a calm, patient relationship with Bitcoin, seeing it as a tool for preserving value over time rather than a game to be won or lost in a single TR. Acknowledging that even the strongest monetary system is not free from risk. Bitcoin offers scarcity, independence, and a new way to store value. But it also exists in a world filled with uncertainty. Technology evolves, governments respond, and markets behave in ways that are often unpredictable. Understanding Bitcoin means accepting both its promise and its limitations at the same time. One of the biggest risks comes from regulation. Governments are not used to money that operates outside their control, and many will try to fit Bitcoin into existing legal frameworks or restrict how it is used. Some countries may embrace it, while others may attempt to discourage or even ban it. These actions can create fear in the market and lead to sharp price movements. Even if Bitcoin itself cannot be shut down, the way people access it can become more complicated, and that matters for adoption. Technology is another area of uncertainty. Bitcoin's code is strong and battle-tested, but no system is immune to potential flaws or future challenges. Advances in computing, changes in cryptography, or unexpected vulnerabilities could alter how the network operates. While thousands of developers and researchers constantly monitor and improve Bitcoin, the fact that it is software means it will always require vigilance and adaptation. There is also the risk of human behavior. Markets are driven by emotion as much as logic. Hype can push prices far beyond reasonable expectations, and fear can drag them far below. People who buy Bitcoin without understanding why they own it are more likely to panic when prices fall. This creates cycles of boom and bust that can be financially and psychologically exhausting. Long-term success depends not just on Bitcoin's design, but on the ability of individuals to stay grounded through volatility. Another risk is overconfidence. Believing in Bitcoin does not mean ignoring the value of other systems, skills, or forms of wealth. Bitcoin is a powerful tool, but it is not a complete solution to every financial problem. Diversification, education, and adaptability still matter. The future will likely include a mix of old and new financial structures, and those who do best will be the ones who can navigate both. The fifth keynote is about realism. It recognizes that Bitcoin is a revolutionary idea operating in an imperfect world. Its strength lies in its transparency and its rules, but its journey will be shaped by politics, technology, and human nature. Understanding these risks is not a reason to avoid Bitcoin. Everything we've talked about comes down to one simple idea. Money is changing, whether we are ready for it or not. The old system was built on trust in institutions, promises made by governments, and numbers on a screen that can be created at will. For a long time, that worked well enough. But as debt grows, currencies weaken, and financial systems become more fragile, people are starting to feel the cracks. Bitcoin didn't create this shift. It simply revealed it. What makes Bitcoin different is not just its technology, but what it represents. It is the first form of money in history that is governed by rules instead of people, by mathematics instead of politics. Its limited supply, its open network, and its resistance to manipulation give it a kind of honesty that traditional money no longer has. When people choose Bitcoin, they are not just choosing an asset. They are choosing a different relationship with value, one that is based on ownership rather than permission. At the same time, this is not a story of certainty or guaranteed success. Bitcoin will continue to face resistance, volatility, and doubt. That is the price of challenging a system that has existed for generations. But every cycle of fear and every moment of instability brings more people to the same realization. Having a form of money that cannot be inflated, frozen, or controlled is no longer a luxury, it is becoming a necessity. The real question is not whether Bitcoin will survive. It is whether individuals will take the time to understand what it offers before the world fully catches on. In the end, Bitcoin is less about getting rich and more about staying free in a financial system that is quietly moving away from fairness. Those who see that early don't just change their portfolios, they change the way they see money itself.